Mr. AG here. Asian guy bringing you the complete picture. Gold just bounced 3.1% to $4,916.98 per ounce. Silver recovered from below $65 to nearly $75. On the surface, this looks like the storm is over. The recovery is here. Everything is going to be fine. But I need to tell you something. What happened this week will go down in financial history. Traders are already calling it the Warsh Meltdown, a systemic liquidity rupture that wiped out trillions in paper wealth in a matter of days. Gold crashed 21% from its peak of $5,594 to an intraday low of $4,403. Silver cratered more than 32% from above $115 to find a tenuous floor near $71. The debasement trade that dominated investor psychology since 2024 is dead, and the scars from this week will influence market behavior for years to come. Let me break down exactly what happened, why it happened, and what it means for where we go from here. Before we dive in, let me be absolutely clear about something. I do not sell courses. I do not sell signals. I do not sell mentorships. I do not have any paid products of any kind. I share this analysis because so many of you have told me this content helps you understand what is really happening in markets, see both sides of every situation, and make more informed decisions. That is why I do this. I present the data, I show you what the bulls are seeing and what the bears are seeing, and I let you decide. Now let me get into what actually happened, because understanding the magnitude of this event is critical. Drop a comment right now. Where are you watching from? What country? What city? I want to see how global this community has become. And while you are down there, tell me honestly, did you get caught in this crash? Were you long gold or silver when the Warsh news hit? Or did you see it coming? I want to hear your real experience. Let me know in the comments. Now let me walk you through Friday's price action first, because it provides context for understanding the bigger picture. Spot gold rose 3.1% to $4,916.98 per ounce by mid-morning Eastern Time. This recouped losses posted during a volatile Asia session that followed a fall of 3.9% on Thursday. Gold was headed for a weekly gain of about 1.3% despite all the chaos. U.S. gold futures for April delivery gained 1% to $4,939.70 per ounce. The U.S. dollar index fell 0.3%, making greenback-priced bullion cheaper for overseas buyers. That dollar weakness was part of what enabled the bounce. Jim Wyckoff, senior analyst at Kitco Metals, explained what was happening. The gold market is seeing perceived bargain hunting from bullish traders. That is a direct quote, bargain hunting. After a 21% crash from the highs, some traders saw opportunity and stepped in to buy. But here is the critical context Wyckoff also provided. Gold's rebound lacks momentum, and the metal is unlikely to break records without a major geopolitical trigger. The bounce is real, but it is not powerful. It is not the beginning of the next leg higher. It is a technical recovery within a larger structural breakdown. Meanwhile, silver rose 5.3% to $74.98 per ounce after dipping below $65 earlier. But silver was still headed for its biggest weekly drop since 2011. Down over 10.6% for the week, following steep losses the previous week as well. Let me repeat that. Silver's biggest weekly drop since 2011. That is 13 years. We have to go back over a decade to find a week this bad for silver. Wyckoff added something else that I think is critical for understanding where we are. What we are seeing in silver is huge speculation on the long side. After years in a boom cycle, gold and silver now appear to be entering a typical commodity bust phase. That is a significant statement from a senior analyst at a major precious metals platform. A bust phase, not a correction within a bull market, a potential bust phase. Let me ask you something. What time is it where you are right now? Morning? Afternoon? Late night? Drop it in the comments. I am curious when people around the world are watching this analysis. Are you catching this before markets open? After they close? Let me know. Now, let me explain what actually triggered this historic collapse, because understanding the cause helps you understand what comes next. The primary spark was the surprise nomination of Kevin Warsh to succeed Jerome Powell as chair of the Federal Reserve. Announced by the White House on Friday, January 30th, 2026, the move caught markets completely off guard. Warsh is known for his hawkish leanings and staunch defense of the U.S. dollar's purchasing power. He represents a radical departure from the accommodative stance of his predecessor. His nomination signaled a definitive end to the era of perceived monetary subordination, where investors bet that the Fed would prioritize government debt sustainability over inflation control. What does this mean in plain English? For years, the market believed the Fed would never truly tighten monetary policy because the government needed cheap money to service its debts. That belief drove the debasement trade. Buy gold, buy silver, buy anything with finite supply because the dollar will be debased forever. Warsh's nomination killed that narrative instantly. Immediately following the news, the US dollar index underwent a violent short squeeze. Capital flowed back into the greenback. This created what analysts are calling a massive air pocket for precious metals. Gold had become a crowded safe haven trade with many investors using it as a hedge against a politicized Fed. When Warsh's name was put forward, that narrative died. And when a crowded trade unwinds, it unwinds violently. The technical fallout was exacerbated by CME Group. They implemented 5 separate margin hikes in just 9 days, 5 margin hikes in 9 days, including a 33% increase for gold and a 36% increase for silver. Each hike triggered more forced liquidations and margin calls. Each round of liquidation pushed prices lower. Lower prices triggered more margin calls on remaining positions. It became a self-reinforcing cascade that overwhelmed the market. The market conditions leading up to the crash have been identified by analysts as a classic technical blow-off top. Gold's monthly relative strength index had reached an extreme reading of 90 in late January. That is a level historically associated with imminent reversals. The market was stretched to the absolute limit. And then the Warsh shock provided the catalyst for that stretched rubber band to snap back violently. As the shock hit, market makers struggled to provide liquidity. This led to flash crash conditions where gold gapped down hundreds of dollars in single trading sessions with virtually no intervening bids. There was no one willing to buy. Prices simply fell through the air until they found buyers much, much lower. Quick question for the community. Did any of you see the Warsh nomination coming? Did you have any idea that this kind of policy shift was possible? Drop it in the comments. I'm asking because the surprise element was a huge part of why this crash was so violent. If the market had time to prepare, the move would have been more orderly. Now let me talk about the geopolitical side of what is happening because it is also affecting precious metals. Iran and the US started high-stakes negotiations via Omani mediation on Friday to try to overcome sharp differences over Tehran's nuclear program. This is a developing situation that could affect safe haven demand. Gold is a traditional safe haven that does well in times of geopolitical and economic uncertainty. Any progress in Iran-US negotiations could reduce safe haven premium and gold prices. Any breakdown could add premium back. Wyckoff noted that gold is unlikely to break records without a major geopolitical trigger. The flip side is that a major geopolitical trigger could spark a sharp rally. Spot platinum added 3.2% to $2,052 per ounce. Palladium gained 4.9% to $1,695.18. Both were still down for the week, but participating in Friday's broader precious metals bounce. Now let me explain the full magnitude of what analysts are calling the Warsh meltdown, because I do not think most people understand how significant this week was. The commodities supercycle of the mid-2020s hit a violent brick wall. Gold prices, which peaked at a staggering $5,594 per ounce in late January, plummeted to an intraday low of $4,403 by February 2nd. That is a brutal 21% correction that wiped out trillions in paper wealth in a matter of days. The carnage was even more pronounced in silver. The devil's metal lived up to its volatile reputation. Silver cratered by more than 32% from its year-to-date high, falling from levels above $115 to find a tenuous floor near $71. This sudden evaporation of liquidity sent shockwaves through the global financial system. What happened was a systemic liquidity rupture. The mechanisms that are supposed to provide orderly markets broke down. Margin hikes forced selling. Selling pushed prices lower. Lower prices triggered more margin calls. More margin calls forced more selling. The system went into a negative feedback loop that no one could stop until the leverage was wrung out. About 60% of you watching right now are not subscribed to this channel. If this analysis is helping you understand the magnitude of what just happened, if it is showing you angles that mainstream media is not covering, consider hitting subscribe. I do not do hype. I do not do fear-mongering. I give you the complete picture and let you make your own decisions. If that approach resonates with you, subscribe. Now let me talk about the impact on mining companies, because this is where the real-world consequences become visible. The impact on mining equities has been nothing short of devastating. Major producers have seen their market caps slashed. Fresnillo, the world's largest primary silver producer, found itself in the eye of the storm. The company was already reeling from a production guidance cut issued on January 28th, which lowered silver targets due to declining ore grades in its Mexican operations. Then, the 32% drop in the underlying metal price hit. For a company whose margins were already being squeezed by rising operational costs in Mexico, the collapse in silver prices has raised urgent questions about the viability of its 2026 dividend. Antofagasta also suffered heavily despite its primary focus on copper. The Warsh meltdown was not limited to precious metals. Industrial metals were swept up in the flight to cash, as the stronger dollar made dollar-denominated commodities more expensive for global buyers. Antofagasta, which had seen its stock double in 2025 to reach all-time highs, saw those gains evaporate as analysts at major banks issued swift downgrades. Other industry heavyweights were not spared. Newmont and Barrick Gold both saw double-digit percentage drops as massive institutional rotation out of the inflation hedge sector took hold. For these companies, the sudden drop in the spot price of gold means that high-cost mines that were profitable at $5,000 per ounce are now facing the prospect of being placed on care and maintenance if prices do not recover quickly. The leverage that provided such high returns on the way up has now become a double-edged sword for the entire mining sector. Let me ask you directly, do any of you hold mining stocks? Newmont, Barrick, Fresnillo, any of the juniors? Drop it in the comments. I want to understand how this community is positioned. The mining sector has been devastated this week, and I want to know if that is affecting people watching this channel. Now let me explain the broader significance of this event because it marks a turning point in the global macroeconomic landscape. For the past 2 years, the prevailing market trend was the debasement of everything. Assets with finite supply, like gold, silver, and Bitcoin, were bid up on the assumption that central banks would never truly tighten again. The nomination of Kevin Warsh has shattered that consensus. This event reintroduces the concept of positive real rates, a Fed that is willing to defend the currency at the expense of asset prices. This fits into a broader trend of returning to hard money fundamentals after years of speculative excess. The ripple effects are extending far beyond mining. Competitors in luxury goods and electronic sectors, which are major consumers of gold and silver, may see a short-term boost in margins as their input costs fall. But this is likely to be offset by the broader deflationary pressure the meltdown has introduced. Historically, crashes of this magnitude often lead to years of consolidation. The 2011 silver peak, the 2013 gold drop, both were followed by extended periods of sideways to lower price action. This systemic liquidity rupture may serve as the catalyst for a much-needed cooling of the global economy, potentially averting a more catastrophic hyperinflationary scenario. But at the cost of immediate market stability, regulatory and policy implications are also looming. The speed of the flash crash and the role of mechanical margin hikes have already drawn the attention of the Commodity Futures Trading Commission. There are growing calls for a review of how margin requirements are adjusted during periods of high volatility, to prevent the kind of mechanical failure seen this week, where the very mechanisms meant to protect the market ended up accelerating its demise. What country are you watching from right now? Drop it in the comments. I want to see the geographic spread of this community. And tell me whether you think the CFTC should review how margin requirements work. Is the current system broken? Let me know your thoughts. Now let me give you the complete bearish case because you need to understand all the reasons precious metals could continue struggling. The bearish case starts with the death of the debasement narrative. For years, the bull case for gold and silver rested on the assumption that central banks would never meaningfully tighten. They would prioritize government debt service over inflation control. They would let the currency be debased. Warsh's nomination kills that narrative. If the new Fed is serious about defending the dollar and maintaining positive real rates, the fundamental case for precious metals as a debasement hedge is weakened. The technical damage is severe. Gold crashed 21%, silver crashed 32%. These are not normal corrections. These are trend-breaking moves. The blow-off top at extreme RSI levels suggests exhaustion of the bull trend. Breaking these levels and recovering them quickly would require enormous buying power that may not exist. Analysts are warning about a bust phase. Wyckoff at Kitco explicitly said gold and silver appear to be entering a typical commodity bust phase after years in a boom cycle. When senior analysts at major platforms start using the word bust, that should give every bull pause. Mining company fundamentals are deteriorating. If spot prices stay at current levels or fall further, high-cost mines become unprofitable. Production cuts follow. But production cuts in a falling demand environment do not necessarily support prices. They just mean a smaller industry. The dollar strength may persist. If Warsh implements hawkish policy as expected, the dollar could remain strong for an extended period. Strong dollar environments are historically difficult for precious metals. Institutional money is rotated out. The massive flows out of the inflation hedge sector represent real money leaving. That money does not come back quickly. Institutional investors who just got burned will be cautious about re-entering for months or even years. That is the bearish case. It is comprehensive and based on what just happened. Now let me give you the bullish case, because the bears are not telling the whole story. The bullish case starts with the bounce itself. Gold rising 3.1% and silver rising 5.3% shows that buyers are willing to step in at lower levels. Bargain hunting is occurring. That creates a floor. The crash was driven by forced liquidation, not fundamental selling. 5 margin hikes in 9 days forced traders to sell regardless of their view on long-term value. When forced selling ends, prices can recover. The fundamentals of supply and demand have not changed. Only the price has changed. The geopolitical backdrop remains uncertain. Iran-US talks could break down. Other global hotspots remain active. Any escalation in tensions drives safe haven flows into gold. One headline can change sentiment quickly. Central banks continue to accumulate gold. While Western investors were selling, central banks in Asia and elsewhere continue to add to reserves. That structural demand has not disappeared. The industrial demand for silver remains. Solar installations continue globally. Electronics manufacturing continues. The applications that require silver are not going away. The extreme nature of the crash suggests oversold conditions. When you see 32% drops in silver and 21% drops in gold, those are capitulation level moves. Capitulation often marks bottoms, not beginnings of further declines. Analysts still see value. The Reuters poll of 30 analysts projected 79.50 as the median silver forecast for 2026. While that poll was taken before the worst of the crash, it represents professional opinion that silver has value above current levels. The $4,400 level in gold may hold as a floor. Many analysts believe that level represents significant support. If it holds, recovery can begin. The new Fed chair is not confirmed yet. Warsh's nomination was the shock, but nomination is not confirmation. The confirmation hearings could reveal a more moderate stance. Any sign of softening could spark a relief rally. Let me ask the community. Based on everything I have shared, do you think this is the beginning of a bear market in precious metals? Or is this an opportunity to buy at much lower prices? Drop your view in the comments. I genuinely want to know what this community thinks. Now let me talk about what comes next, because understanding the path forward is critical. In the short term, the market is looking for a period of stabilization. The extreme volatility needs to calm down. The margin call cascade needs to end. Traders need time to reassess positions. Many analysts believe the $4,400 level in gold may hold as a temporary floor. But a return to the 5,000 plus heights is unlikely until the Warsh Fed clarifies its roadmap for the balance sheet. That clarity will not come for months. Warsh needs to be confirmed first. Then he needs to take office. Then he needs to communicate policy. That is a long process. Mining companies will likely be forced into strategic pivots, focusing on high-grade, low-cost assets, potentially pausing expansion projects that were greenlit during the peak of the mania. This could lead to a wave of consolidation in the sector, as cash-rich majors look to acquire beaten-down juniors at a fraction of their January valuations. Strategic adaptations will be required for investors who have spent years positioned for a weak dollar. The emergence of a strong dollar-high real rate environment challenges traditional portfolio construction. The all-weather strategies that leaned heavily on gold as a stabilizer need to be reconsidered. Market opportunities may emerge in the form of oversold mining stocks, but only for those with the stomach for extreme volatility and a long-term horizon. The primary challenge will be navigating the transition from a speculative bubble to a fundamental-driven market. Watch for Kevin Warsh's confirmation hearings in the coming months. Any further hawkish rhetoric could provide a second leg down for metals. Any sign of softening could spark a relief rally. The confirmation process itself becomes a catalyst. Now, let me share what I am watching over the coming days and weeks. Watch the $4,400 level in gold. That was the intraday low. If it holds on retests, that is constructive. If it breaks, lower levels come into play. Watch the $71 level in silver. That was the floor during the worst of the crash. If it holds, buyers are defending. If it breaks, more pain follows. Watch the dollar index. Dollar strength or weakness will significantly impact precious metals. Any reversal in dollar strength would help gold and silver recover. Watch the Iran-US talks. Progress reduces safe haven demand. Breakdown increases it. Headlines from Oman could move markets. Watch for any CFTC statements. If regulators signal they may review margin mechanics, that could affect market structure. Watch mining company earnings and guidance. Any production cuts or mine closures would signal how severely the industry is being impacted. Watch fund flows. When institutional money stops leaving and starts returning, that signals the worst may be over. 3 key takeaways and then we are done. Number 1. Gold bounced 3.1% to $4,916, and silver recovered from below $65 to nearly $75. Bargain hunting and a weaker dollar supported the bounce. But silver is still headed for its biggest weekly drop since 2011, down over 10.6%. The bounce lacks momentum, according to Kitco's Wyckoff. Breaking records will require a major geopolitical trigger. After years in a boom cycle, gold and silver appear to be entering what Wyckoff calls a typical commodity bust phase. This is not just a correction. This may be a regime change. Number 2. The Warsh Meltdown represents a historic event. Gold crashed 21% from 5,594 to 4,403. Silver cratered 32% from above 115 to 71. CME implemented 5 margin hikes in 9 days, including 33% for gold and 36% for silver. The debasement trade that dominated since 2024 is dead. Warsh's nomination signals a Fed willing to defend the dollar at the expense of asset prices. This systemic liquidity rupture will influence market behavior for years to come. Number 3. Mining companies have been devastated. Fresnillo, Newmont, Barrick, and others saw double-digit percentage drops. High-cost mines may be placed on care and maintenance if prices do not recover. The leverage that provided returns on the way up has become a double-edged sword. Regulatory attention from the CFTC on flash crash mechanics could lead to changes in how margin requirements are adjusted. The transition from speculative bubble to fundamental-driven market will take time and require strategic adaptation from all market participants. Let me leave you with this thought. The Warsh Meltdown of February 2026 will go down in financial history as one of the most rapid destructions of value in the commodities market. The key takeaway is that no asset is immune to the laws of gravity, especially when fueled by excessive leverage and a one-sided narrative. The sudden shift in Federal Reserve leadership proved that the central bank put has its limits, and the credibility of the US dollar remains the ultimate arbiter of global asset prices. The golden age of the 2020s has been replaced by a hard reality. The safety of gold has been called into question. The volatility of silver has once again served as a warning to retail speculators. Moving forward, the market will likely be characterized by a more sober, data-dependent approach. Whether you view this as catastrophe or opportunity depends on your positioning, your time horizon, and your ability to stomach volatility. The fundamentals have not disappeared. The demand has not evaporated, but the narrative has changed. And in markets, narrative often matters as much as fundamentals. Know your time frame. Know your risk tolerance, and position accordingly. The easy money has been made. What comes next requires discipline, patience, and clear thinking. Do your own due diligence. Understand the risks. Be accountable for your own decisions. Have a clear plan and know your time frame. The volatility may continue. The opportunity may be real, but so is the danger. Only you can decide how to navigate this new environment. Drop your thoughts in the comments. Where are you watching from? What is your outlook now? Do you think the golden age is truly over? Or is this just a reset before the next leg higher? I read every comment, and they help shape what topics I cover next. The market has spoken, the regime has changed. Stay sharp, stay informed, and make decisions based on data and logic, not fear and emotion. This is Instar AG, Asian guy bringing you the complete picture. I will see you in the next one.